Inflation has not peaked, and it's poised to set new highs in 2024. At least that's according to Michael Burry, who spent the beginning part of 2023 issuing warnings about inflation and the economy and what's ahead. And then even more recently, he tweeted this one-word tweet, which is pretty self-explanatory about his opinions about where the market is going. Now, Michael Burry's warnings might seem a little bit odd because we're already seeing inflation come down. Inflation has come down quite a bit off of its peak, and we keep hearing the government say that there's no economic pain or recession ahead. This is where Michael Burry more recently responded to all the doubters and the critics with this tweet. This is a chart of the stock market during the 2000 dot-com crash, and what you'll see is that in the year 2000 we saw the stock market fall, and then in the year 2001 we saw the stock market rally and look like it was very strong right before 2002 hit, and then the stock market continued to go down and set new bigger lows. Essentially what he's saying is that we're in the calm before the storm. But the reason why Michael Burry says that inflation is going to go higher in the next year might not be why you expect. According to Michael Burry, we're already in a recession, period. And there's no ifs, ands, or buts about that. But then he says that this recession that we're in is going to get worse later on in 2023. And then this future economic pain that we see in 2023, maybe into 2024, is going to force the Federal Reserve Bank and the government to then start stimulating the economy, which will lead to even higher inflation in the future. Let me just read you what he says word for word, that way you know what I mean. Inflation peaked, but it is not the last peak of the cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the United States is in a recession by any definition. Then the Fed will cut and the government will stimulate, and we will have another inflation spike. It's not hard. He tweeted that in the beginning part of 2023, and then more recently he compared what we're seeing in the markets right now to the 2001 crash. But this is essentially the cycle that he's saying. The 2020 to 2021 pandemic stimulus, all the money printing, then led to the high inflation that we saw in 2021, into 2022, and even now in 2023. But then this high inflation led to the higher interest rates that we saw happen in 2022, and now the Federal Reserve Bank raising interest rates in 2023. These higher interest rates that we're seeing is causing a slowdown in the economy. We started to see the slowdown a little bit in 2022. He says that we're going to see the full effects of the slowdown later on in 2023, especially in the second half of 2023. This economic slowdown is going to then force the government and the Federal Reserve Bank to increase stimulus as early as the second half of 2023. If not 2023, he says it could be 2024. And then this increased stimulus, the new money printing, the new quantitative easing, the new cutting of interest rates will then lead to a new rise of inflation sometime in the future. Maybe as early as 2024, maybe 2025, but he says that this will create a new inflationary cycle. Now, Michael Burry, for those of you who are unfamiliar, is the guy that predicted the 2008 crash, and he shorted the housing market before the crash happened and made a lot of money. There's a movie called The Big Short that's made about Michael Burry, so he gained his wealth and his fame after that, and this is what he's now predicting. And one of the common themes that we saw then and now has to do with timing. Now, of course, we have been covering all of this, what's happening, when it's happening, in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs, it's a super simple way for you to stay up to date on what's happening in the markets, especially if you're investing your money in the markets. We keep you up to date on the housing market, the stock market, crypto, the global economy, and our own economy. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. Now, if you remember the movie, The Big Short, one of the things that happened was you had a few people, including Michael Burry, who were looking at the real estate market, and they saw all the red flags in the real estate market, and then they started making investments based off of the red flags that they saw in the housing market. And then when they thought the crash was going to happen, it didn't happen. We saw 2005, all the red flags started popping up. 2006, everyone expected the crash to happen, but it didn't happen. 2007, we thought the crash would happen, but it didn't happen. It wasn't until 2008, many years after people thought the original crash was going to happen, until the real pain started to come. So one thing that I want to remind you is that nobody can perfectly time the market, no matter how smart you are. So this is where I want you to understand that, yeah, we do have red flags in our economy. We have red flags with inflation. We have red flags with a slowing economy. We have red flags with the interest rates continuing to rise. All of these things are red flags. But when most people expect something to happen is not typically when it happens. And this is where you have to just understand the psychology of the markets, where if everybody predicts something to happen at a particular time, it typically does not happen at the time. This is why patience is so important as an investor, because the way you make money when you see any sort of market crash is you buy good assets at a discounted price. When the 2020 pandemic hit, the people that went out and bought good assets, stocks at a discounted price, were able to make a lot of money very quickly. When the 2008 crash happened, the people that bought stocks at the bottom made a lot of money. The people that bought real estate at the bottom made a lot of money. During the 2000 dot-com bust, the people that bought stocks and dot-com companies that were strong at the bottom were able to make a lot of money. We've seen this trend for a century now, where when you see these types of recessions and market crashes, it creates opportunities for people who can then go out and buy these assets at a discounted price. So you have to be financially educated and you have to be prepared. Prepared meaning you have access to money to actually buy. Financially educated means you know what investments are actually a worthwhile investment. You know how to actually put your money to work, and you have that education to know that when things go down, it creates opportunity. Now, this is where patience becomes so important for two reasons. For one, when you go to actually invest your money, you have to be patient enough to continue building this cash buffer to actually have money to invest. Because when people are hoping that it's going to happen tomorrow, well, now it can make you very impatient, because you're sitting there saying, you know what, I didn't buy myself this new car because I wanted to invest my money, and I haven't seen this happen yet, so I'm going to go out and blow all this money and go buy a new car. So you have to be patient when it comes to actually making the investment, and then you have to be patient on the flip side for your investment to actually make you money, because unlike previous recessions and previous crashes, we didn't have inflation as an issue going in. In all of our previous modern recessions, inflation was never an issue until now. That meant that when we stimulated before the 2020 pandemic, when we opened up the money printer before the 2008 crash, when we started quantitative easing during the dot-com bubble burst, inflation was never a concern. So when the recession hit, and we saw this type of quantitative easing and cutting of interest rates and stimulus by the government, inflation wasn't an issue, so they were able to do that more openly. Today, we're already facing an inflationary issue. Our inflation is still extremely high. It's way higher than where we want inflation to be. That means now whenever the government and the Federal Reserve Bank start increasing stimulus, it's going to have an even longer and more lasting effect. Even today, the Federal Reserve Bank, Jerome Powell, says that the reason why they want to continue raising interest rates and monitoring inflation correctly is because if we don't get inflation under control now, it's going to be an even bigger and more painful problem to solve in the future. Now, this is where Michael Burry and a lot of people are predicting that, hey, the Federal Reserve Bank is not going to have the backbone to continue doing the higher interest rates and holding interest rates high when we see the economy slow down, because there's going to be a lot of pressure on them from the government, from people to say stimulate, to fight off this slowing economy, because when that happens, then the Fed is going to lose the backbone, and then they're going to start cutting interest rates to stimulate the economy. Now, of course, this is a big question mark. Maybe the Fed will suddenly say, you know what, no, we're going to do what's right for the dollar. We're going to do what's right for the long-term health of our economy. We're going to do what's right for the country, and we're going to continue to raise interest rates, and we're going to continue to keep interest rates high to bring inflation down. Now, if they do that, that's going to cause more pain in the economy. But this is where Michael Burry is saying, I don't have the faith in the Federal Reserve Bank to do that. Now, of course, we don't know what's going to happen until it actually happens, but this is that big debate. Here we are right now. We're seeing higher interest rates and we're seeing the economy start to slow down. Now, what's going to happen next? The higher interest rates are probably going to continue to stay high until something breaks. If the economy continues to go down, well, then that could break the Federal Reserve Bank to then start cutting interest rates. If that doesn't break, then it's going to be inflation. So the question is, what's going to break first? Is it going to be inflation, bringing inflation back down to 2%, or is it going to be the economy? And this is that game that the Federal Reserve Bank is playing, and this is where you have the government that's hoping that inflation will get under control without causing any major pain in the economy. We keep hearing how we have no pain in the economy ahead, how we don't have to worry about a recession, how the economy is booming. Well, we heard the same thing in the 2008 crash, and we heard the same thing during the 2000 dot-com bubble bursting, and this is why Michael Burry is saying that this sounds familiar to the 2001 era, where we saw markets start to rally, we saw things start to just settle before things started to set new lows. So what he's saying is be prepared and understand what will happen if we continue to raise interest rates, because that will cause more pain in the economy, and more pain in the economy could force more stimulus. And if we see more stimulus, that could cause higher inflation. Now, is he guaranteed to be right? Of course not, but this is where you want to be an educated investor, understand what's happening. That way you can make the best decisions for yourself. That way you can take care of yourself, your family, and your community. And this starts by you now building a savings cushion, that we have some cash to protect you in case you lose your job, in case the economy goes down, in case your income goes down. You have income to protect you. Second, you need to have cash that we can actually capitalize on assets at a distressed price. Because now when you can go out and buy assets at a discounted price, well, now you can build your wealth even sooner. This is where the financial education and preparedness comes into play. Now, I have a lot of videos on my channel going over how to invest your money, so you can check those out. But if you want to stay up to date on what's happening, Market Briefs is there to help you do that. If Amazon sees their stock crash, well, now you can see your value drop in half almost overnight, because you can see these huge swings in stock market valuations very quickly, because the stock market is liquid and it can be very emotional. With the housing market or with real estate, it's a little bit different. You can still see swings up and down, but you're not going to see